Welcome to Community Health Watch. My name is David Hawley.
And my name is Juanita Allen Kingsley, and this show is sponsored by Century Health Systems, the parent company of the Natick Visiting Nurse Association and New Century Home Care Services.
Today on our show, we have Tobe Gerard, the owner of Tobe Gerard Insurance, LLC. What about, say, for instance, I buy health and long-term care insurance today, and 20 years down the road, healthcare has completely changed. How is this going to blend in or help me?
Sure.
You know, because I purchased something that I'm expecting something, but maybe I don't need it now. Maybe it's part of the healthcare process. So what happens?
Right.
Is there some? Do I get my money back, or you know, I mean, or some? Is there some way that this can be passed on to someone else, or?
Okay, we've got a
Explain.
lot of questions
A
wrapped
couple,
in that
yeah,
one.
they're
Okay,
all kinda
we'll
like-
pick it apart a little bit.
Yeah.
Well, first of all, what we know today, you know, we cover today. I mean, we know that long-term care insurance is meant to pay for home care from skilled right down to the rudimentary level of someone making
homemaker,
meals.
yeah.
Home care. We cover assisted living, we cover adult day programs, we cover nursing home, and we cover hospice. In our policies today, we have something that wasn't there years ago. It's called an alternate care benefit or alternate care something. Each company might, you know, name it a little differently. But what it really is to respond, you know, to your kind of question, David. If in the future something comes about that might be able to allow me to stay home longer or do something for me, it allows the policy to respond, because I always look at it as the futuristic provision. It's there so that if there is something available that we're not aware of now, that at least it could be considered in the future. I mean, we could be talking about robotics in the future. I mean, now they've already got these little care bots that can help ambulate people in nursing homes. So we really don't know what's out there, but you want to know that due to that alternative care benefit, that the policy can respond. Where I thought you were going with that question was, how are my benefits going to increase over time? If I buy it now in my 50s, what are they going to be when I'm 80? I mean, is everything going to stay the same? Is it going to grow? How do I deal with it not becoming meaningless?
Yeah.
And I think that question is all about inflation. You know, if you're buying a policy in your 40s, your 50s, your 60s, you've got to put some kind of inflation component in to really drive that, to leverage where you need it to be. I mean, long-term care itself, as you know through the VNA, the cost of it goes up every year. So the policies need to grow. Whatever benefit you pick, it needs to grow over those years. So it'll double and then double again.
Because if you had $150 a day coverage, so to speak, these days that can be half of what you need at a skilled nursing facility for long-term care, for instance. Now, can a family member be providing that care for you?
Under the long-term care policies, can a family member, you know, generally I'm going to say no, and then I'll get specific. Generally, the most liberal they're going to be might be friends and neighbors. They might say that your family member could help out if the family member came to your home and they were employed by the home care agency. But generally speaking, these policies are not meant to pay for immediate family providing care. Now, there's two ways to go on that. One is a member of the immediate family could certainly be trained so that they could be an uncompensated caregiver. And most of the policies today do build in some kind of caregiver training, so that if I wanted to help provide care for my husband, I don't want to hurt him, I want to know how to turn him properly and all those things, I could get that training. There are a few policies out there that actually do provide some kind of a cash benefit, which basically means that instead of sending in receipts to be reimbursed, you will take a lesser amount of money, but you get it in cash, and then you don't need to provide any receipts. If in fact you're getting a cash benefit, that would be one way you could pay family, because they're not looking for you to justify any kind of receipts. So it's not necessarily where I think most people are going to go, because I think predominantly people want to use professional places like you know, the VNA and your supporting organizations.
Great.
What about those, say for instance, now there are particular programs out there, that caregiver programs where, say for instance, for some of the insurances, they're allowing a family member to be that designated caregiver. If they have that classification, it still wouldn't pay for it at all?
Yeah, I mean, if somebody decided, for instance, to get their CNA designation, and they went through that course, you know, and they're independent and they can farm themselves out and work wherever they want, that's fine. But if they're an immediate family member, you know, they're not going to be able to provide your care unless there was a cash benefit. My husband's a nurse, as an example. Now, the only way that he could provide my care is if he was coming in as an employee of the employer who was providing my care through a home care agency. But just normally, could I use him as an independent nurse and be reimbursed for that? I could not.
Okay. Great.
Is there any way that, say, for instance, if on some of the policies that if nothing is used, say, for instance, I had long-term care insurance and I expired, is there any way that that money is recouped on some of these policies?
Is there any cash value, or is it strictly a term product?
Well, sure. There's actually, you know, two different ways you can go with that. The first, what I think you're leading at, Dave, is some kind of return of premium, which that is what we call a rider. In other words, it's not a basic component part of the policy, but you've got your component parts, and then you have a list of things you can add on and pay for. Return of premium does exactly that. It basically says that if you didn't use your policy, you've paid in a lot of premium over the years, and they would give back to whoever you listed as the beneficiary all those premiums. Some companies say they will give back the premiums less any claims they've paid out. The one thing with return of premium is it's a very expensive rider. So in that sense, you really need to look a few times. The other way to look at it would be as far as if you were a couple and you had a joint policy. Let's say you bought a policy where together you were sharing a 6 or an 8 year benefit. If one of you expired, what's remaining in the policy, not money, you're not going to get back money, but you certainly have that whole benefit still available to you if one of you expires and hasn't used any of the policy or has used very little.
That's fascinating, Toby.
It's exciting.
Wow.
There are definitely a number of shared options out there where people can either purchase a joint policy, which would really mean one policy, you're sharing a policy with a certain amount of pot of money to it, and whoever needs it dips in.
Excellent.
Which is one option. And then the other option is what we call a shared rider. It would mean you each purchase individual policies. They have to be exactly the same. They have to mirror each other. And you connect them with a rider. So if I exhausted my 3-year policy, I can now, with that rider, access, you know, my husband's policy. So that's an option for couples that should be looked at. You know, you want to check out the different pricing. Does it make more sense to buy a bigger individual policy? Does it make more sense to share? And again, you should always get a variety of options from the person you're getting quotes from. It shouldn't be what they want to sell. It should mirror more what you're asking to look at as options for yourself.
Wow, fascinating.
It's a lot, yeah.
Yeah, it is. Well, my thought would be, this is a pretty sophisticated product, and you've just given us a little bit of things. Do you ever give seminars to folks who call in and say, we don't want to think about buying, we just want to learn?
Sure. You know, I do a lot of adult ed teaching. A lot of the towns have asked me to teach, you know, like a 2-hour class on long-term care insurance, just really basic stuff so they can get comfortable with the terminology. I actually meet with a lot of people that never buy long-term care insurance, and that's the whole point. I mean, you're exploring it, and you're going to meet with an agent to say, I don't know if I'm going to do anything, but right now, maybe it was my financial advisor told me I need to look at this, or my estate attorney said I should look at this. And you just want to look at it and get some pricing, and you don't even know if it's going to fit in your budget if you haven't looked at it. So absolutely, agents should always be willing to meet with people, and it should take about an hour to actually walk through the coverage itself and then some numbers, some actual premiums. And then the person is at least armed to decide if it's going to fit in their budget or not.
Great.
So.
What about, say, for instance, can the supplemental care, say, for instance, that an individual have, can they go into like a hospital setting, nursing home setting? Say, for instance, an individual wanted extra care for their loved one while they're in the hospital. Are they allowed to do that, do you know?
As far as using your long-term care insurance in a hospital, no.
You
I mean,
can't.
again, the hospital piece of things is really under the medical component. The long-term care part that most people use is for custodial care at home. That's what you're really using it for, because if it's going to fall under the hospital, you're not really going to be, you know, bringing in someone to provide long-term care in that setting.
I think you're talking once people have rehabbed to the point they're going to be,
Right.
you step in to create that ongoing comfort.
Correct.
for
I mean, let's say
somebody.
someone's really used all of their medical coverage. Maybe they're Medicare age, and they've used their Medicare, and they've used their supplement, and now it's time to go home from that skilled nursing or skilled rehab. But let's say they had a stroke, and they still have residual damage on one side of their body. They still can't dress themselves, cook for themselves, all those things. They're going to need care. Without long-term care insurance, they don't really have a lot of options. I mean, they can pay for it themselves. You know, you can self-insure. That would be our very wealthy person we talked about earlier. You could hope that your family could help out, but in most cases, most family members, you know, are working or they're raising children. You could hope maybe if you're a veteran that there might be some benefit through the VA, but that's going to be very limited. Or you could hope to qualify for Medicaid, which means you're going to have to spend down your assets and your income to get yourself to that almost poverty level. So, yeah.
Is it the, when you're talking like long-term care, is it more the money amount, say for instance, or is it that the services provided? Say for instance, if I had a family member who I felt really needed to have some speech therapy, are they paying for what the dollar amount, say for instance, for a speech therapist would be, or are they just giving me like X amount of dollars and I use it how I want to?
That's a good question too, because it could kind of go in two
We are
different,
running out of time, I think.
you know,
so.
kind of go in two different directions. When someone's using their long-term care, there's actually a plan of care in place that's adhered to. And that is, you know, put together and decide upon what does that person need. Now, in the case of the stroke victim, they may need some skilled nursing. They might need some speech and occupational therapy. They might need the services of someone helping with the bathing and the dressing and those things. I think what you're asking is, how does that all get pulled together? Basically, your policy pays $1 per day or $1 per month, and the insurance policy is going to respond up to that $1 per day or $1 per month that you have. So obviously, if you're having a lot of home care, there's going to be at least one bill, maybe more than one bill coming in. You present those to the insurance company. It would be the insurance company's job to reimburse. You're always going to be fronting the money, though, for at least 1 month. That's just the way it works, because the insurance company's reimbursed by receipts. Your question briefly was, could it ever be a different way? There are policy provisions where you basically buy $1 per day, and as long as you submit even one receipt, they give you that full dollar amount. That's called indemnity, and indemnity is not that, you know, easily available nowadays. But that would be the only option where you could get money to a certain extent and do what you want with it, but you still have to produce at least one receipt to do that.
Well, we never think of ourselves as getting old. You know, we all wait till the last second, and then we're thinking, geez, why didn't I buy long-term care insurance, or why didn't I think of a retirement fund? I think that you've given us a lot to think about today. I'd like to thank you for being on the show. Tobe Gerard, from owner of Tobe Gerard Insurance. Thank you very much.
Sure, my pleasure, David.
Thank you. I'm Juanita, and remember that it's our responsibility to take care of ourselves and each other. We'll see you next month.
Great, thank you, Juanita.
Thank you.